The information provided in this program is of a general nature and is not intended to be personalised financial advice. We encourage you to seek appropriate advice from a qualified professional to suit your individual circumstances. Banks are making bumper profits, but for how long can the good times keep rolling?
It tends to get whittled away, so I suspect we've seen the peak now.
And Apple impresses the market. iPhone sales are solid as the tech giant makes moves into finance.
I think what we can see now, Apple might be finding some new growth area to satisfy its investors.
It's Monday the 8th of May and you're watching Markets with Madison. Well, it's pretty hard to please everyone in this world, but it's especially hard if you're a banker right now. Our biggest banks are making record profits at a time when borrowers are in distress. ANZ has made a half-year net profit of $1.1 billion and BNZ $800 million, both by fattening their net interest margins. I caught up with ANZ's Chief Executive Antonia Watson just after its result was released to the market. Antonia, thank you so much for joining us. Really appreciate your time. Now, look, I want to ask you about profitability first. Do you feel like you have to defend ANZ's profitability, and is that a bit of a weird position to be in?
I'm really glad you use the word profitability because I feel like we have to defend our profits because, look, I understand it's a big number. You know, it's $1 billion in this half, which is a big dollar number. But equally, we're just very big. We've got $200 billion of assets. I mean, it's hard to even picture what that actually means. Profitability-wise, KPMG did some work earlier in the year and we're about middle of the road when it comes to the NZX. So, you know, I understand why the question's asked. It's that relative thing, you know, relative to other companies in New Zealand, we're about middle of the road.
And I guess relative to what's happening in the economy at the moment too, right? So you've actually mentioned with this result that you are starting to see a material impact on borrowers with these high rates that are starting to come through. You've provisioned more money, 860 million New Zealand dollars in total. How bad could this economic environment get? How much of that provision could you have to dip into?
Part of it depends on whether we get the inflation beast under control, I think, because if we see interest rates keep going up significantly, that would be really tough. The other thing that would make it really tough is that if unemployment increases significantly. I mean, we're still at pretty much full employment and people seem to feel pretty secure in their jobs. And that's a massive boost to confidence and people's confidence and their ability, and they're getting pay rises, so their ability to continue servicing that debt. We're still, you know, we've got about 45 basis points of our entire mortgage portfolio, which is a tiny amount, is over 90 days past due. You know, people have been tightening their belts over the last few years. That number is about back to where it was pre-COVID, which is still kind of a historic low. So we're in really good shape for if things get worse, I guess. I mean, and I'm not an economist, I can't predict where it's going to go, but really pleased with the position we've put our customers in and the position our customers have put themselves into in terms of saving and paying down debt early.
Now, I want to go straight into asking you about your net interest margin. That did increase year on year by 21%. In the past 6 months, it's up by 6%. I want to ask how you decide how much of a margin to make in this environment. How do you get the balance right between supporting shareholders but not aggrieving borrowers? And do you feel like you're hitting that balance right at the moment?
Yeah, look, it's something we spend a lot of time thinking about. I think we've got the balance really well at the moment. If you have a look at some of those key terms, we've actually put up deposit rates more than we've put up lending rate over the time since the OCR increased. And the OCR has increased 500 basis points now, or 5%. We haven't passed that amount on either side of that full amount on either side of the balance sheet, because that would be, you know, that's a big thing to swallow if you're a borrower. So, you know, it's always a careful balancing act. We've seen margins expand over the last couple of halves, but there's almost a lag effect. You know, automatically, mathematically, interest rates go up significantly. That flows into bank margins because of things like the non-interest bearing accounts we have. Over time, people have got their money in non-interest bearing accounts, go, gosh, I'd like a term deposit because I can get over 5% now, and you see that flow into term deposits. You see it flow through our wholesale funding book. You know, some of those, there's a bit of a price lag, and you see fierce competition. So it tends to get whittled away, so I suspect we've seen the peak now.
Where should investors expect to see your margins go next?
Well, as I say, I think we've probably seen the peak. You know, it's something we always try to carefully manage. We'd hate to see it fall off a cliff because, as we've talked about, we want strong, stable banks to make sure that we can help support our customers through the tough times. but I feel like there's probably more tailwinds on margin now than there are headwinds.
What do your Australian owners think of how the New Zealand bank is going at the moment?
If you listen to Shane today, I hope he'll be really positive. All our businesses have done really well this half across the Australian businesses, the international businesses, and New Zealand. So I'm looking forward to hearing some nice things about us.
Their net interest margins are typically quite a bit smaller than New Zealand's. Why is that?
Depends on what you're looking at. So they report a group number. We have our New Zealand business, excluding our institutional business. If you compare the New Zealand retail portfolio, which is, mums and dads and the people out there, to our retail portfolio, they're actually about the same.
Now, one thing that the Reserve Bank of New Zealand raised in its financial stability report was about you being owned by these Australian banks. In regards to your profitability, said that your operational costs were typically lower because a lot of it happens across the ditch and doesn't actually need to happen, and you don't need to pay for it here in New Zealand. Does that scale and efficiency not mean that you then don't have to increase interest rates as much as competitors are?
Well, I think that you've seen that no one has increased interest rates as much as the OCR. But the interesting thing is that the economies of scale that we have from being owned out of Australia have played out really significantly as we've implemented BS11, which is the RBNZ's outsourcing policy. We've seen our costs increase because now we have to be able to separate from our parents within 6 hours for some things and overnight and other things. So actually, we're far more separate from them now than we were in the past.
Your Australian owner didn't quite like the idea of us increasing our capital requirements here. How has that played out? Because your profits are doing pretty well. Does the idea still annoy them?
So dollar profits are doing well. Our return to our shareholder has gone down, and that's what we anticipate would happen. Customers have worn a bit of it. That effectively, to increase the capital, the Reserve Bank's saying you've got more risk-weighted assets, and if a customer's more risky, you tend to price it a little bit sharper. So customers have worn some of that increase in capital. Shareholders have worn some of that increase in capital. We've put an extra $3.3 billion in so far. That's a lot of money, and you don't do that for free, right?
Now, I want to ask you about stress testing. I actually spoke to John Key at the end of 2021, ANZ's chairman, and he told me that at that point you were stress testing borrowers for mortgages at around 6%. That is now below the average mortgage rate, right? Was that a mistake in hindsight? I know that hindsight's a lovely thing, but should you have been stress testing borrowers at a higher rate?
Hindsight is a lovely thing because no. At the time, that was a huge margin. If you actually pumped out if you wound up the calculator was saying we didn't even need to test customers that high. We were saying, well, actually, interest rates are really low. We think we won't lower that rate. So, there was a huge amount of conservatism in there. What's happened is an unprecedented steepness in the increase in the OCR, effectively.
And one thing that does come with interest rates rising at this sort of historical pace is interest rate risk. And I know that the Reserve Bank has come out recently and said that, banks like yours don't face the same risks as US bank failures that we've seen. But I do want to ask about your securities books. We've been told that banks like yours don't hold as many bonds, therefore don't have as many risks as the likes of Silicon Valley Bank and recently First Republic Bank. So what securities in terms of type are you holding on to?
And we also mark them to market. So Silicon Valley Bank was doing a particular type of accounting treatment. The reason we don't hold as many is because we lend more of our deposits out. And the American banks aren't as big a lenders as ours. It's a really strange thing to get your head around. So we have things like New Zealand government bonds would be the biggest example. We have sovereign level, highly rated liquid assets, we call them, because we need things that we can sell if our depositors needed their money back. And the problem with Silicon Valley Bank was that they needed to sell them, and they had to sell them at a price lower than what they were holding them on in their books, whereas we're marking ours to market.
How has that changed from the price that you purchased those at to the market value that they're currently sitting at? How significant is the drop?
So it depends on the bond, because effectively if we had a bond, a New Zealand government bond that was paying 1%, say, on our books, a New Zealand government bond, I don't know the numbers, but let's say it was paying 3% now, well, it's not that attractive to buy the 1% one, is it, when you can go out and get a 3% one? So that is why the value of the lower interest rate bond goes down. So as interest rates go up, bonds that are paying lower interest rates, naturally their value goes down. At the end of the day, if you can hold them to maturity, you still get your money back. So it sort of doesn't matter, other than if you have to sell them, and that's what we saw with Silicon Bank, they had to sell them.
Has ANZ here or in Australia made any changes to any of its security investments or any of its asset to liability matchings off the back of what's happened in the States?
No, we've looked at it really hard, as you can imagine, but we're really comfortable with the position we're in. We have all sorts of regulatory hurdles, reporting requirements, things that we look at every day to make sure we haven't breached certain limits, and all those things help us be very comfortable that we can't be in that position like a Silicon Valley bank.
Thank you so much for your time, Antonia. Lovely to catch up.
Pleasure.
Speaking of banks, they may have an unsuspected competitor in Apple. The tech giant is making more moves into finance and doing pretty well out of it. Its second quarter earnings were flat per share, but did beat the market's expectations. Revenue dropped again, but was still better than expected too. It also announced an increased dividend and a $90 billion share repurchase plan. Well, Tina Ting covers Apple for CMC Markets. Hey Tina, thanks so much for coming on the show.
Thank you for having me.
Anytime. Apple, what did you like about its earnings this time around?
Apple's earnings today came out stronger than expected. I think it just represents the overall US big tech earnings performance for this financial year. So Apple's earnings, especially its iPhone sales, beat the expectation this time, just because China's reopening has really boosted the iPhone sales in the financial year quarter two. And also its earnings per share beat expectations too. I think iPhone sales is looking bright just because of China's reopening.
Their revenue was down though for the second consecutive time, just by 3%. But how significant is another drop in revenue, do you think?
Well, I think amid the current macro headwinds, all the big techs showed the decline in the revenue growth. It's just a broad sentiment. However, I think Apple's earnings still showed a positive results to the financial markets, where we can see actually the U.S. shares market futures now today has rebounded from last night's drop. However, like you said, it is the second quarterly decline for Apple's growth. But what we can see here is notably that the service revenue just grew for the second consecutive quarter, which is very positive for investors. And also from my personal view, I think Apple might now is transferring from this hardware concentrated business to the software development. And recently that launched the high yield saving account. I think what we can see now, Apple might be finding some new growth area to just satisfy its investors.
Yeah, I was actually just about to ask you about that. You've already mentioned that iPhone sales were pretty impressive, so they had a record March quarter for these earnings. But services, they had an all-time record. How much opportunity do you see in revenue growth on services for Apple?
I think Apple now, especially the recently, the Apple Card is entering into like a fintech territory, which we can see right now because the U.S. regional banks Herald actually provide opportunity for Apple to develop in this area. I think that's why probably the Tim Cook just think probably it's a good opportunity. Now we launched the saving account, give higher yields to absorb the savings deposits. So I think that's a new growing area for Apple. And the Apple TV is also competing in this live stream market. So we can see here now, Apple is really just trying to thrive into the service territory, which it can see probably more momentum in the service revenue.
Yeah, how much of a surprise was it to you? It certainly was to me when Apple came out with the savings account. Is that a different trajectory that really no one expected Apple and Tim Cook to go on?
Was a little bit surprised for me. I think Apple just right now it's such a headwind in the macro investment. What I was thinking because Apple just launched this buy now pay after app service. I don't think it was a good timing for this company to launch this service. However, I think in the long term it's a good growing prospect in this area. See right now the macro play out like the Fed is heading to a little bit dovish. Probably they will ease rate hikes in the second half of the year and boost this liquidity in the markets. And also Apple now entered this fintech company, absorb the savings and develop the service area. I can still see the long term as a good growth area for the Apple to keep growing its revenue.
What about AI? Has Tim Cook said anything about artificial intelligence?
I think Apple is preparing to compete in this AI industry. So it's launched this headset, 3D headset, which could like competing with Meta platform, this 3D headset. And also I think overall in the software services, Apple has like a rich cash and they can have lots of money to invest in AI. And I still think it's just the front runner of AI industry and leads the industry be further developed.
Tina, how much of an advantage do you think Apple has to win in all of those areas we've just talked about, in fintech and also in things like artificial intelligence? Because so much of what all of us do day to day is on an iPhone, is on an iPad. They kind of already own us, right?
I think the advantage of Apple is still an iPhone-driven business at this stage. However, it is transforming from this hardware-connected business into some kind of like AI-driven software business. And they actually, first, they financially solid. And the second, I think Tim Cook is not like a Meta platform. They just like reckless developing into this metaverse. So I think that's a more steady pace for them to develop. And it's the largest market cap company, and they're strong. They have supporting team. They have the talented people who can really just support this area to further develop and compete in this market.
Thanks so much for your time, Tina.
Thank you very much, Madison.
There's a few things to watch out for this week, team. US inflation figures and another bank earnings result from Westpac. No doubt plenty more will happen on markets unannounced, so if there's anything that you want me to look into, just let me know. Now go put your money to work. Thanks for watching Markets with Madison, the New Zealand Herald show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.